Hello, welcome to the next in our series of webcasts on demystifying IFRS 9's impairment requirements. I'm Sandra Thompson. I lead our global accounting technical function on financial instruments, and we help our financial services clients in this area. And I'm very pleased today to introduce you to our two presenters. Mark Randall, who's been very active in the UK helping our UK banking clients, who's presenting with Chris Wood. Chris is a Canadian banking partner and has been helping our clients out there as they look to implement IFRS 9. Chris and Mark are going to talk today about stage 3 assets. Those are assets that are credit impaired. So I'll hand over to Mark.
So for credit impaired loans that move into stage 3 and still have the lifetime expected credit loss provision against them, there's two key areas I think it is worth covering. The first is around the equivalence between IAS 39 and IFRS 9. As often people describe stage 3 as being the equivalent to what you've got as an incurred loss under IAS 39. That might be true in many cases, but it isn't always going to be the case. So let me talk you through a couple of reasons why that isn't going to be always the same thing. The first relates to this concept in IAS 39 of so-called incurred but not reported provisions. So an example might be a mortgage customer, they've lost their job 2 months ago, but they haven't yet missed any payments, but the incurred loss event has occurred. And under IAS 39, the definition of incurred loss allows you or requires you to have a provision for those types of cases where there's been an incurred loss, it just hasn't yet been reported to you. That part of the definition within IAS 39 is taken out in the IFRS 9 definition of credit impaired. So that's going to be one reason why there isn't going to be exactly the same provision in stage 3 as there might have been under IAS 39. The second reason really relates to the whole concept within IFRS 9 of considering multiple economic scenarios in the future. Quite often, banks, when they are modelling their incurred loss provisions under IAS 39 for a distressed loan, will base their cash flows on their single most likely outcome, sort of their plan A in terms of their workout strategies. However, if you move into an IFRS 9 world requiring you to look at multiple scenarios, I guess the key question is, well, does that plan A always work? Do you never have to fall back to plan B, which might result in materially higher losses? If that's the case, then the question under IFRS 9 really has to be, well, why don't you need to be considering those multiple scenarios and the different outcomes that might arise, and really stepping back to make sure that your provision is probability weighted and a true reflection of what you expect the expected outcome to be. So there are two reasons why you might have quite a significant change between your IAS 39 provision and your stage 3. Another question we often get is whether a collateralized loan against which there might be very little or possibly even no provision, should that be in stage 3? And I think the key thing to think about here is that for the purposes of measuring your provision, your ECL, collateral is very much something that should be considered and taken into account. But in terms of the staging, what really matters is the risk of default. And for that purpose, is collateral almost always is a separate consideration. And so for that reason, collateralized loans very much can be, and in many cases should be, in stage 3.
From a practical perspective, there are a couple of things that we need to think about as well. And one is sort of this concept of forbearance. So one of the indicators of credit impaired under IFRS 9 is that the lenders made concessions to the borrower as a result of the borrower's financial difficulty that it otherwise wouldn't. And so a lot of forbearance activities, things like interest payment holidays or other payment holidays or payment rescheduling, might now be indicators that something's in stage 3, it's credit impaired. So one of the things that we need to do is kind of inventory all of those different forbearance activities that we might undertake and assess whether or not those are indicators of things being in stage 2, a significant increase in credit risk, or stage 3, credit impaired. One of the other things that we need to think about is distinguishing stage 3 financial assets from the subset of stage 3 called purchased or originated credit impaired. And what that really means is that we might have financial assets that don't really start in stage 1, but instead we determine that they're impaired on day 1, and so they actually start out in stage 3. And that's important because although we measure the expected credit losses on purchased or originated credit impaired financial assets the same way we would for other financial assets. The way that we book them is a little bit different. The big difference is that for purchaser-originated credit-impaired financial assets, we actually bake the ECL into the carrying value on day one. And so what we end up with is really just the change in the expected credit loss over time flowing through the income statement. So the big difference that you might end up with there is that you might actually have a net impairment gain flowing through the income statement on your purchaser-originated credit-impaired financial assets. What I mean by that is that we might have more gain flowing through the income statement related to impairments that really were never booked through the income statement to begin with. Just a word of caution, high credit risk doesn't necessarily mean credit impaired. And so we might have some types of loans like payday loans or other loans that we make that are at high rates of interest and are subject to high credit risk, but that doesn't necessarily mean that they're purchaser originated credit impaired.
Thanks, Chris. So a number of things to think about there, but in terms of takeaways, the key one for me would be that if you think that IAS 39 incurred loss is just going to be a lift and drop, and that's your stage 3 credit impaired provision under IFRS 9. Unfortunately, life is more complicated and there are a number of different things to think about there. Thanks for watching this video. Look out for our next sessions and click on the button below if you want to subscribe to further videos. Thanks a lot.